How's it going, everyone? My name is Dan, but you can call me Malone, and I just wanted to take some time today to discuss tax in Ireland. Over the past couple of weeks, we've seen lots of developments in the tax space. Tax-related news stories such as the OECD Global Minimum Corporate Tax Rate, the changes to the rate of stamp duty attributable to bulk purchases of residential property, and the local property tax changes spark lots of conversation online. The fact of the matter is that tax is highly dynamic and is always in a constant state of change. One of the main reasons for this is because the tax system at its core is used as an instrument to promote or disincentivize certain economic activities depending on what the needs of the country are at that particular point in time. With that being said, because there's so much change happening all the time, it can be hard to keep track of the important information, hence why we're here today. In my opinion, it's so important that you're clued in with the tax developments in the country. The reason why is because tax reform features on nearly every political party's promotional material around election time. And if you don't have a good understanding of the tax system, you're less likely to understand what they're talking about, or even worse, more likely to fall foul of unrealistic tax policy propositions. So without further ado, let's get started. Let's start off with the biggest ongoing tax development at the moment, the OECD minimum global corporate tax rate of 15%. The Organization for Economic Cooperation and Development, or OECD, is made up of 38 countries around the world, with Ireland being one of these 38 countries. The idea proposed by the OECD is to reform international taxation rules and ensure that multinational companies are paying their fair share of tax wherever they operate. This will be achieved in two pillars. The first pillar ensures that companies are paying tax in countries where they have business activities and are earning profits, irrespective as to whether those companies have a physical presence in those countries. This pillar will negatively impact Ireland's tax revenues because we're a current beneficiary of this perceived unfairness. Essentially, the likes of Facebook could have their European headquarters incorporated in Ireland, meaning that the company is liable to Irish corporation tax on the worldwide profits associated with that company. Facebook may then go on and earn millions of euros in profit in the likes of France and Germany. And if Facebook didn't have a physical presence in those countries, France and Germany wouldn't actually have the right to tax those profits. It would be Ireland who would hold the right to tax. Now, that is a massive oversimplification which doesn't account for the many taxation treaties that Ireland has with other nations around the world, which are designed to tackle issues such as this. But that's the general gist of the idea. The second pillar introduces a minimum corporate tax rate of 15%. The idea is to prevent countries from having to reduce their corporate tax rates to remain competitive with other nations, the effect of which would reduce the amount of taxation revenue that the country collects. Ireland was one of the few countries who did not sign the deal. And the reason why we didn't sign the deal is largely because of pillar number 2. Our 12.5% corporate tax rate has helped us to become a major player when it comes to foreign direct investment. In reality, even though the headline rate is 12.5%, companies are paying a much lower effective tax rate than this thanks to the various tax reliefs available which our legislation permits. The question is whether or not it's fair to impose competitive restrictions on setting a baseline corporate tax rate and imposing those restrictions on nations of unequal sizes. The other question is whether this is just the beginning. I think Pascal Donoghue was right to not sign the deal immediately, if not for just the sake of appearances. But I do think the deal will be eventually signed and our corporate tax rate will be increased to 15%. Ultimately, Ireland will remain a highly competitive location for multinational companies to do business, and I've no doubt that other incentives will be introduced to account for the changes. The next piece of tax news that I want to discuss concerns pay-related social insurance, better known as PRSI. This isn't actually one which hits the headlines frequently, but I guarantee you that it'll be a point of contention in the coming months and years. When you pay PRSI tax, your money goes into the Social Insurance Fund. The Social Insurance Fund is used to finance social welfare payments, such as the state pension. Now, when there isn't enough money going into the Social Insurance Fund via PRSI contributions, the state has the ability to dip into general taxation revenues to fund the gap. The Irish Business and Employers Confederation, or IBEC, submitted a report to the Pensions Commission where they suggested that rates of PRSI will have to increase for both employers and employees over the coming decades in order to offset the increased costs of an aging population. This makes sense because, as we know, over 65s are set to double by 2050 in Ireland. More people in retirement means more people claiming the state pension, and that money has to come from somewhere. The report goes on to note that the most recent actuarial review of the Social Insurance Fund put the annual gap between PRSI income and outgoing payments at the equivalent of €15 billion at 2017 prices. This would have significant implications for fiscal sustainability. In this context, the state will have three options to begin to pay for increased pensions costs. Number one, an increase in taxation through increased employer and employee payments to the Social Insurance Fund via PRSI. Number two, reduced expected future pension benefits for some or all future retirees in real terms. Number three, increase the retirement age over and above what had been planned before the 2017 review of the Social Insurance Fund. In reality, the solution will likely be a combination of those options, but none of those options are favourable for the Irish taxpayer. We've actually talked a lot about the implications of this issue indirectly on the channel, and anyone who's been around here for a while will know that I'm a big advocator for investing in private pensions. Private pension investing is a key part of the solution to this very expensive problem. In fact, one article recently put the cost of this problem to the state at €221 million for 2021 alone. What's likely going to happen in the future is that the state pension will be means tested, meaning that your entitlement to the full state pension will be determined on the basis of your available sources of income and capital. The idea is that only those who really need the state pension will receive it, while the rest of us will be left to survive on our savings, personal investments, and private pensions which we've accumulated over the course of our lives. But that only works if people have other sources of income in the first place. This is where the likes of auto-enrollment comes into play, a system whereby employees are automatically opted into private pension investing as soon as they commence employment. The current system requires employees to opt into pension schemes, whereas the new proposed system will require employees to opt out of pension schemes. The hope is that by doing so, Irish citizens will build up their private pension pot over time, thereby reducing their overall reliance on the state pension in retirement. However, as we know, starting a pension is one thing, but contributing enough to that pension to sustain your standard of living in retirement is another. The last piece of tax news I want to discuss relates to stamp duty, specifically in respect of residential property. In last week's video, we discussed how the government introduced an increased rate of stamp duty tax of 10% on bulk purchases of residential property. This was in response to the 112 newly built homes which were snapped up by Roundhill Capital and SFO Capital Partners earlier in the year. The original intention of this tax policy was to disincentivize investment funds from buying up large portions of new builds in the country and renting them out to the highest bidder on the market. Remember, at the beginning of the video, we said that the tax system at its core is used as an instrument to promote or disincentivize certain economic activities depending on what the needs of the country are at that time. So originally, this policy was used as an instrument to disincentivize the economic activity of buying residential property, specifically by investment funds. But then the government actually passed an amendment to the tax legislation which actually exempted these funds from the increased rate of stamp duty tax, provided the residential properties that they purchased were leased back to the council. This time, tax policy was actually being used as an instrument to promote this economic activity in order to expedite the provision of social housing. The point I'm trying to get at here is that you need to understand that the government uses tax policy to try and achieve certain short, medium and long-term goals, hence why tax is in a constant state of change. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below, leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers!